Let's see. Yep, there it goes. Okay, let's see if I can do this. So, the lecture today is what is a mutual fund? A mutual fund is a company that starts up and tries to attract investors. Investors who want to give them money. They take the money from those investors and they buy stocks, bonds, whatever investments that are along the lines of what that mutual fund was started for. There's different types of mutual funds based on what they're going to buy. The reason you go buy mutual funds is because they're traded like stocks and they move up and down based on what stocks are in their portfolio, what else is in their portfolio. They're easy to buy into, but the big key, the vocabulary word here is diversification. You get instantly diversified into that mutual fund, whatever that mutual fund is bought, and it makes it much, much easier. On top of that, the other things that you get is you get somebody trading for you, so you don't have to trade. Somebody who it's their full-time job to try and make that mutual fund go up, because if they make the mutual fund go up, then there's more investment, then they make more money. The professional management side of it. They're also really, really low cost. It's easier to actually buy into mutual funds a lot of times than it is to buy into stocks. They're just as liquid, if sometimes more liquid, and because of that, it makes it really easy to trade in and out of them. Doesn't cost you anything. They're very liquid, just like a stock traded on the stock market is, and so you get all of the benefits really of owning stocks with instant diversification. Also, it allows you to get into particular areas without having to know so much about one particular company. You can say, I want to get into, let's say, healthcare, pharmaceuticals, because that's one of the things we've been doing. Instead of buying into a individual pharmaceutical company that could totally screw you over, you instead buy into a mutual fund that is, let's say, a sector mutual fund for just pharmaceuticals. And that would give you the opportunity to have a bunch of pharmaceutical companies, ones that whoever your professional manager is has decided is a really, really good investment or a group of investments. They've done their research for you. You can get into that sector. They also give really good service. They want you to keep your money with them. They want you to leave your money in there for the rest of your life and for you to pull money out of that account just like you would pull it out of a savings account. That's where they want you to leave their money. And so it has all of the great advantages of stocks. The disadvantages of mutual funds is that because they're diversified, they're not going to perform like a regular stock. And so they're not going to be as volatile, but you're also not going to get the upside. Let's say you buy a pharmaceutical stock and it goes up 400% because their drug is approved. And you guys just, you rock it. That's great. That's wonderful. And it can also go down, as everybody's found out, as you're trading. In a diversified portfolio, in a mutual fund, you're going to have some of them go up, some of them go down, and you're going to end up with a more moderate growth. The costs for some mutual funds are higher. That's one of the things with mutual funds. When you're buying stocks from a broker, you know what it's going to cost most of the time to buy. Different mutual funds have different costs, both on purchase as well as continuing costs inside. And so they can go. You have to look into that when you're buying a mutual fund. There are different levels of risk. Even though they're diversified, they're not diversified to the point where there is no more risk because they can be all in one sector. And if that one sector goes bad, let's say housing. If you bought a housing mutual fund, which I did own back in 2007, we had quite a bit in housing because it was doing great. When it went bad, when all of those building companies and real estate companies and other things that we owned, everything in that mutual fund went down. That mutual fund sank hard. And then also you can't get rid of systemic risk. Even though most of our money was in mutual funds in one of our accounts, that account still got killed because when the entire economy goes down, it goes down. And then it's also open for the same level of taxes as any other stock invested mutual fund. Now, mutual fund companies are interesting because there's different types of mutual fund companies. The first one is what we call an open-ended mutual fund company. They'll take investments anytime, all the time, anytime. And the second type is a closed-ended mutual fund, which means that they're not open for new investment. When somebody sells, then they open up what's been sold to somebody else to buy in. There's pluses and minuses for both. An open-ended mutual fund is great because you can get in any time. There's always new money coming in. They're always investing new money. they're growing. That can be good. It can also be bad. A closed-ended mutual fund is bad if you can't get into it. It can be bad because they don't have money coming in when there might be market opportunities. But at the same time, in an open-ended fund, when they have money coming in all of the time, they have to invest it. So right now the market is crazy high. Everything is high. All of the P&Es are really high. There's really nothing that's on sale, which is when you want to buy things. You want to buy low and sell high. Right now everything's high, so you don't want to buy stuff. But if money's coming into your mutual fund in an open-ended mutual fund, you have to buy, and so you're buying high. In a closed-ended mutual fund, they don't have any money coming in, and so they can pick and choose when they buy, when they sell. A little bit better. All of my money personally is in closed-ended mutual funds because I like that idea better in the long run. The next one is a REIT, REIT. It's an acronym, stands for real estate houses, investment trust. You can invest in real estate three ways. One is by buying your own place, buying a house, buying a condo, whatever it might be, a rental unit. The second way you can invest in real estate is by buying land and building it up and then selling it, what we call speculation, spec homes and whatnot. The third way that you can invest in real estate is through a REIT. And what that is that you basically pool a bunch of people's money, like a mutual fund, where a bunch of people put their money in. And then instead of going and buying stocks, you go and buy real estate. So you get 100 people together, they each put in $100,000. Now you've got $10 million, and you go buy a strip mall. Then people go into the strip mall, they rent your strip mall from you. They rent the stores from you. And then you get money each month from the rent. REITs are the best dividend-paying stocks. They pay really, really high dividends. When you guys go in and research, I want you to go in and look at and find one REIT that pays a dividend of over 7%. You don't see that on any other stocks, but you see it in REITs. You also get capital appreciation from that as the value of the land goes up. The problem is commercial real estate is fickle. It's all over the place. I mean, look at how many places there are that are brand new, really nice, and then 2 blocks down the road, there's an old strip mall that has 2 pawn shops in it and 2 vacant things. And so it's pretty risky. You get a really good dividend, you get some capital appreciation. You're not going to get a ton of capital appreciation like you would on some growth stocks. But they're kind of a middle ground in between bonds and stocks in terms of you're going to get some dividends out of it. Not as much capital appreciation, more dividends though than you'll get out of a value stock or out of bonds. All right. Don't worry about unit investment trust. We'll just skip that. Let's go to types of mutual funds. So different types of mutual funds, kind of going from the safest to the riskier. Money market mutual funds, which is just a money market type savings account. They go get a bunch of different money markets and invest in a bunch of different money markets. The idea with a money market, and we'll talk about this in another chapter, is that you get 1 share equals $1, and then you get paid a dividend, usually about 2 or 3%. The key to that is that you can get multiple money markets. Those multiple money markets are going to then give you different interest rates, but they'll average out pretty high. Takes away basically all the risk out of a money market investment by going into money market mutual funds. The next one that's a little bit more risky is tax-exempt money market mutual funds. Those invest in government securities, bonds that talked about last week. There are tax-exempt bonds and munis, the municipal bonds, and they invest in those. The mutual fund, the money markets invest in those. The mutual fund invests in the money markets that invest in those, and so you get tax-exempt growth, but it's not going to be very much. The next one is government securities money market mutual funds, which is just a little bit more taxable, a little bit higher interest. And then the big ones, the different stock mutual funds. So they're categorized by what they're investing in. So first, aggressive growth, which is you go crazy for companies that are really small and really come on strong. It's really, really risky, but you can totally, like, this is the kind of company or kind of money market, kind of mutual fund that would have invested in Google back the day that it went public, or it invested in Amazon when it went public. It would also invest in Pets.com, which went completely bust. And so there's a lot of up, a lot of down. The next is small cap, which we talked about. Small companies that are public that can be traded. And it specifically looks for really good small cap companies, which is good because, especially in small cap, it's hard to do investment in small cap. You don't know all of these companies. There's thousands and thousands and thousands of small cap companies every year that are going public, and you just don't have time to do the research on them. You can do research easily on Nike and Amazon and Under Armour, companies like that. But small cap is much harder. These guys do it for you, invest in it for you. I have some of my money in small cap growth funds because I like that. It's a good place to be because you never know when that small cap company becomes a mega cap company. All right, growth. You invest in growth companies, only companies that don't pay dividends. Growth and income, which is the next one down. Growth and income is growth companies and dividend paying companies. It's just a mixture of the two. Income, that only are companies that pay dividends. You're looking for the dividends. I have 4 different mutual funds in one of my investment portfolios. One of them is small cap. One of them is growth and income. One is income. And the other one is international. So let's skip down to international. International is investing in international companies. Another thing that, what do you know about investing in China? What do you know about investing in India? Can you even read the prospectus that they're talking about? No, you can't. But they have somebody that can do that for you, somebody in that country that's doing research. And so I like international funds. They're really volatile because you never know what's going to happen in Burma or in Thailand or in China for that matter, or Brazil or Argentina. All right, some of the other ones that are on there. Value. Value is you're looking for, they're looking to buy low, sell high. Companies that are just discounted at the time. Sector income funds or sector funds, which I mentioned before, you can invest in specific sectors. This weekend, I was watching TV and they were doing these SPDR ETF sector funds that are they're looking at very specific sectors of the economy, healthcare or energy or transportation or any sector of the economy that you can think of. There's a fund that invests in that. So you can diversify yourself, super diversify. You could buy 10 different sector funds in different sectors of the economy, so you can invest in every sector of the economy. And then inside of those, they'll be invested in 100 different companies. And now at this point, you own 1,000 different companies inside your portfolio. You did very little research, but you're very, very diversified. All right, index funds. They track an index. So they'll buy all of the stocks under the S&P 500 in the same ratio as the S&P 500. When the S&P 500 goes up 1%, your index mutual fund goes up 1%. All right, balance just means they've already diversified it for you. They've just bought a bunch of different stuff in a bunch of different sectors, and bam, you buy that one mutual fund and you're completely diversified. Same thing with asset allocation. That's all that is just it. They choose different. It's not balanced. It might have higher levels in different asset families or classes that are good for that period of time. All right, this next one is a key one, and I want you guys to look one of these up. This can be your assignment for next time. Life cycle mutual funds. So what a life cycle mutual fund is, I really like them. I'm really tempted to put my money into them. That's where my son's money is for, and my daughter's money is for their college fund. So what it is when do you need the money? What's the date you're going to need the money? Let's say for you guys, you're 16 years old, you're going to retire in 50 years, 66 years old, and maybe a little older, maybe a little younger. But you're going to retire in 50 years. And so that's going to be 2064, right? 2014, 50 years, 2064. You can buy a life cycle fund that for 2064. That's what it's going to be. It's going to have a date on it, 2064, or maybe 2060 to 2070, something like that. And right now, they would invest it all in international and small cap and aggressive growth and all in stocks and really go after it. Then they would, as you get older, they would back off of that a little bit and then back off a little more, back a little more. And by the time you're 60, they'd be in mostly bonds, things that aren't going to go down, and they will change your allocations for you to save you money and make sure that you don't lose money when you need it. When you're young, you can afford to lose money you can also afford to make it all back. All right, bond funds, let's skip that. And exchange traded funds, ETFs. This is a new thing that's come up in the last maybe 10 years. This is what you see a lot of. These are really cheap. They're not actively managed like a mutual fund is. What they do is they buy stocks. They trade on the stock market. You've probably run across them. You see it after the stock. You're looking at it and you're like, oh, what is this? And it says ETF after it. It means exchange traded fund. And all they do is buy a bunch of stocks in a particular area, and then they put it on the stock market, and it trades exactly like a stock. It's very, very cheap. There's no active management, so they don't have management fees. It's a way of buying one stock and having it already diversified. What I like about ETFs is that that's a way to get into, it's my favorite way to get into sectors. So I have some gold ETFs that track not gold prices. It tracks the value of gold mining companies. And so as gold goes up in price, the mining companies get more value because they're going to make more money because gold is more expensive. And so it goes up. I've got a few different ETFs. I bought the one I got screwed on that I've told you guys about is the bank ETF. So I bought into the banks. That's how I bought into banks, was I bought an ETF that it traded banks. All right, let's see where we're going from here. Learning about mutual funds. Morningstar. Morningstar.com is the place to go. That tells you everything you need to know about any mutual fund. They do a really cool job. When you go to buy a mutual fund, they're going to send you a prospectus. That's a key term that you're going to need to know. A prospectus is, what is this company's job? What is their goal? What is they trying to do? Where are they going to put your money and why? And it's basically their little sales pamphlet. But it's really, really good to read the prospectus and know where your money's going to go. Load. Load is a key term. It's how much you're going to pay for the stock. We've talked about that, front load and back load. Front load, you pay the commission up front. Back load, you pay it when you sell. No load means that you're going to pay it all the time, otherwise known as constant load. And there's a word there, expense ratio. An expense ratio is how much does it cost you total with everything, all the load and the management fees and anything else they're going to add in there. What is it going to cost you? Morningstar does a good job of pointing that out. If a stock, or a fund, let's say it makes 10% a year, and the S&P makes 9% a year, it beat the S&P by 1%. But if it has 2%, if it has an expense ratio of 2%, you just lost 1%. You could have just bought an ETF with no added costs and an S&P 500 ETF and made more money. So you need to look at the expense ratios. I always look for things that have expense ratios of less than 0.75%, 0.75%. All right, turnover rate is the last term that you have there, and that is how often do they sell the stocks in their portfolio. The more they turn, the more turnover they have, the more expensive it's going to be. If they buy really good companies and hold on to them, it's cheaper versus ones that are actively traded. Now, you can actively trade and make a lot more money. So it's just one of those things you want to look at. Plus, there's taxes involved with turnover. When you buy and hold, the government likes that, and they want you to do that, so they give you tax benefits. All right, I hope this works. We'll see if it does. We'll try this again next time. Thanks, guys.